All right, let's go ahead and get started. Welcome everybody to our July session of the Roundtable. As you can see there on the cover slide here tonight, we are celebrating 3 complete years of doing this. So we've got 36 months in the can, and hence the cupcake there on the left. I'm joined here tonight by Ken Kavula of the Mid-Michigan chapter and just basically national director for the National Association. And Hugh McManus was intended to be here tonight, but he got whisked away on some last-second business, so he sends his regrets and urges everybody to get out there and buy Caterpillar because he's been buying it and could use the price support. And last but not least, I'd like to welcome a new guest tonight, Matt Spielman, to the group. And Matt is joining us for the first time, although he's a fairly regular attendee in many of the functions around here in the Mid-Michigan area. And he's a respected contributor already to the Manifest Investing Forum. So many of you have seen his name. Now you see his smiling face, even if he did say that that's the type of suit he would wear if he was invited to the captain's table while on a cruise, and we'd have to protect that suit from lobster or something along those lines. Welcome,
Matt. The only
Matt.
way you'll see me in that. Yep.
That's the only way, huh? All right, let's go ahead and get underway. We probably will have a little bit of time for questions tonight. I'm not sure how long Ken will run, but he's usually pretty timely about his stuff. Here's our reminder that no investment recommendation is intended. Everything we do here is for illustration and demonstration purposes only. We're basically showing you how we evaluate stocks, how we go shopping for them, and how we put them through their paces, the gauntlet known as our stock studies. And that further disclaimer, some of the stocks that we do talk about may be held by us or some of the people who comment here tonight in their personal portfolios. Just a quick reminder that this is the Roundtable. We've been doing it for a little while. We think that doing investing together in a group makes us all better, and that's what this is all about. Here's our agenda. Again, if you're joining us for the first time here tonight, an extra big welcome hug to you. A lot of regular attendees, and welcome to all of you also. You know that this is our standing agenda. We basically deviate from this very little. We'll spend some time looking at some of our past selections and results, talking about some of that type of stuff. We do have a couple of challenges in order tonight, but they're not real challenges. One of them is kind of a celebration in honor of guest night Nick Stratasys and his selection of Route 21 a couple of years ago. And the second, again, challenge in air quotes, is a bit of a funeral. We're going to put the hogs to bed tonight. Both of those companies are being bought out, and they've reached the end of their run. Hugh McManus was going to select Caterpillar. Matt's going to cover AZZ Corporation. Ken is going to treat us to a little bit of a perspective on 3D printing and the company 3D Systems, ticker symbol DDD. And I'll close it out with a repeat selection of C.H. Robinson, the trucking and logistics company, and we will leave time for an audience poll. So with that, and particularly if you are new, just a reminder that we're trying to identify kind of our single favorite investment opportunities as participants at this roundtable. We do keep track of a tracking portfolio. We hope that over the long term, that tracking portfolio will beat the general stock market by 500 basis points or 5 percentage points. And we do use the Wilshire 5000 as our general stock market benchmark. We do hope to see 3 out of 5 or 60% as a minimum of our selections actually outperforming the market. We track every single selection. We'll take a look at that here in a second, versus the market since the time of the selection. And we do want that to outperform the market in a mirroring type investment at least 60% of the time. Here's a look at our results. Again, we are celebrating a 3rd anniversary, so we should raise our glasses if for no other reason. In honor of that, we've been doing this now for 3 years, and at the end of the 3-year period, or at least this milestone in the road, we have a slightly positive relative return. It's 0.1%. You can see that it was a little stronger than that last month, and we've kind of sagged back. I almost look at that pattern as like the constellation Orion or some type of Chinese dragon or something, but obviously it's been bouncing around, but the overall trend is actually quite positive. It's one that we do hope to see continue. And you can see that that overall trend is generally in that direction. Our long-term objective is to achieve a 500 basis point or a 5 percentage point advantage to the stock market. That's what's shown by this dotted line here. That's basically the target of many of the investment clubs in the modern investment club movement, and it's our objective also. You can see that outperformance accuracy actually was up at 57% last month, so it's slipped off a little bit, but that is dramatically improved compared to some of the stuff that was going on back here. And we're kind of happy to see some of the stronger performance here over the last 18 months, 12 to 18 months. Any questions or comments on that, Ken?
No, we're clear right now on the board, Mark, so why don't you keep on moving?
Okay, I'm going to go ahead and pull up the top 20 or top 21 holdings in the tracking portfolio. What we do every month is when a company is selected, either by the roundtable knights, the guest knights or damsels, or by audience consensus vote, we take and we invest $1,000 into that particular investment. So let's take the case of Walgreens just to kind of walk you through this. In the case of Walgreens, it's actually been selected 7 times. You'd know that by this little key down here at the bottom. So $7,000 invested in Walgreens is now worth $11,260. So that's actually done quite well. The majority of those selections are by Hugh McManus, and I believe that Ken and I have selected Walgreens over the last 3 years also. So again, it's been selected 7 times and done fairly well. So if you just watch for the multiple selections, you can see how many times that the various positions have been chosen. For example, Southwest Airlines, I believe, is a 2-time selection, shown down here, Southwest Airlines, and that is now worth $3,400. So again, just as an example of one that's actually worked out fairly well. So these are the top 20 selections. Some of them are a little bit more adventuresome than others. But you can see that my selection here for tonight, which will be C.H. Robinson, appears on this list, and C.H. Robinson has been selected 3 times. Any on there reach out and grab you, Ken, or Matt?
Well, Mark, my investment club met this evening before the roundtable, and we bought some more Priceline. So I'm looking the fact that we've chosen Priceline 3 times, and it is positive right now. We think that's a fairly compelling investment right now. We also had a long discussion about ResMed, and we still really like ResMed. I'm not quite sure how many times we've chosen it, but
ResMed is twice by the
twice for ResMed. So that's a pretty good return on ResMed at $3,200 for being chosen twice. Yeah.
Yeah, it's worked out pretty well, and then the return forecast is still 10.8, so probably why it's showing up at your investment club meeting. There was a company that had, go ahead, Matt.
I was just going to say, portfolio recovery has done well too, and although the par looks low today, they just beat earnings again, keeping up their streak, so I wouldn't be surprised if that doesn't get modified up soon.
Yeah, it's been tracking pretty strong for quite a while. It's a company with immense momentum, and maybe if we get a couple extra moments, we might take a look at that, because it's one that has been just kind of ticking away at a fairly low return forecast for quite some time, and some people have been kind of critical of it, but the momentum is just so strong. But you see a bunch of basically community or personal favorites on that list, some that are not terribly surprising, and that's the way the portfolio has performed to generate that slightly outperforming overall tracking portfolio. Here's a look at the condition of the current portfolio, and one of the reasons that we won't spend a whole lot of time looking for positions to weed out or to challenge here tonight, the median return, or the median forecast right now, sits at 5.6%. That's pretty close to historical lows. And the overall portfolio, we try to stay at least 5 points ahead of it, a minimum of 10.6%. You can see we're there. So as we add a couple fairly high return forecast stocks here tonight, we'll actually be boosting that up a little bit. But the overall portfolio from top to bottom, excellent quality, pretty solid growth, although we might like to see that just a tad higher, just a little bit higher for what we're trying to do. Decent projected average PE ratio, again, fairly standard yield, considerable financial strength, and fairly stable companies. There's just a couple non-core selections in the portfolio, fairly well distributed when it comes to sectors, and again, fairly well distributed when it comes to the size diversification that we measure by the sales growth forecast. We might like to lean on perhaps a little bit more of the blue chippers, especially with the stock market near these historical lows for the return forecast. But again, everything is pretty much in order, and one of the reasons that we won't spend a lot of time tonight talking about positions that need to be jettisoned. If there were any positions to be considered for a challenge beyond the two that are being taken out because they're being bought, probably come from this list. These are the 5 companies that have return forecasts lower than the median return forecast, and these two guys up here at the top are pretty close to the market average, and these two guys down here at the bottom are Hugh McManus's non-core turnaround speculation. You can call him whatever you want. His thesis is working out extremely well, and I can give you his thesis in a nutshell without putting too many words in his mouth. He looks at these numbers over here and says, well, okay, but what he really sees is a return to higher return on equity levels at Bank of America than is currently expected by the institutional analysts, and the same thing at Staples, a higher net margin forecast than they really think right now, and that means these two numbers over here might be artificially low, and they might be just because people are a little bit depressed about those companies, and that's basically it in a nutshell. He has higher profitability expectations for those companies than the consensus of people who follow them, and some of the investors who've grown weary. Bank of America has been dramatically good for Hugh in the portfolio, and Staples has actually worked out pretty well also. The only one here that I think is a legitimate, rake it over the coals situation probably is SEI Investments, because that's a more traditional stock that I believe Ken picked a while back. It's actually performed quite well.
It's one of the first picks I ever made in the roundtable, Mark.
Yeah, so it's actually done pretty well, and that return forecast again isn't dramatically lower than the market average, but probably one you might test a little bit if you really wanted to dig in. But again, there's no urgency with the portfolio return forecast being as high as it is, so I just say we move on. Any objection, Ken?
None for me, Mark.
Let's do that then. All right, our two, again, challenges in air quotes. The first is a celebration of Nick Strategos' selection of Rue 21. As a guest night, Nick selected it back on February 27, 2012 at a price of $26.68. So that would have been back in this time frame right here. So again, this is the type of stock that we like to see. It's done pretty well. The annualized total return on it has been 38.3% during a period when the stock market went up 15%. Again, annualized. So the relative return is plus 22.9, and that is very helpful to Herb Lemkool and Nick Strategos' collective performance. They're doing pretty well with their stock picks, and of course Matt is joining that group here tonight. So pretty good stuff. Rue 21, about to be taken private at $42 a share. All right, and our second one that we can talk about a little bit tonight, a really good story going all the way back to November and December 2010. It just hasn't worked out very well. And you can see, again, as we saw in that preceding slide, anytime you get a price pattern like this where it's just absolutely topping out and stopping, same thing happening here. This company is being taken out at $13.50 a share, so we're going to go ahead and close out the 3 positions. And you can see 2 of the 3 didn't work out quite so well, but that's a rarity for Mr. Kavula. And equally rare is for me to end up with a green number over here. So we'll just kind of lick our wounds on this one, pull a little pork. Any comments on this one, Ken?
Well, yeah, in my defense, it was before I figured out that Chinese stocks were really complicated back in 2010. So I was still believing all their numbers and all their hype. So I have some ill-advised choices from back in that time frame, and I've learned my lesson. I really do an extra amount of research and am very wary of the numbers on a lot of Chinese stocks even today.
It's good advice. I think only for the largest of companies like Baidu can you probably put a lot of faith in the numbers. If it's a smaller Chinese company, there's no gentle way to say it. Just be extremely careful. Sometimes things aren't what they seem. And that sort of happened here. And there were other things at work also. Wall Street saw a wounded beast, and they just piled on. And that's kind of what you saw happening back in this time frame here. It really was a lot of bloodshed. No pun intended. So we'll just leave that one go and move on to better days. With that, we're going to turn it over to Matt. Matt has selected AZZ Company tonight, and as you can see, it's got a pretty good looking situation. One of the things that draws my attention to it is as you know, at Manifest Investing, we include the numbers for year-end 2013, 2014. Well, these are pretty strong expectations there on the right-hand side. So with that, go ahead and take it away, Matt.
Great, thanks, Mark. Do I take control, or somebody give me control?
Yeah, we can go ahead and give you control if you want.
Okay, well, we can go through the slides. So let's talk about AZZ. This is a company, I think, in a sector that no one on this call is going to be overweighted in. It's an industrial and it's an electrical supply company. Pretty boring, what you might think of more as income investing territory. But it's small. So last year it had $570 million in sales. This year, thanks to a big acquisition, they'll do a lot more, and they have mastered their niche. So they have two main business lines. The first is electrical and industrial, which is what they started on. They actually date back to 1956. And so this is at all levels of power generation and transmission. So they don't do generators, they don't do the big plants, they do a lot of things that connect them together. Transformers, substations, parts for power lines, and then when you get to customers, as they take power off those lines. So they have a lot of small pieces in this full distribution center. Next one. The other business line is galvanizing, and I hope this picture comes through okay. So galvanizing is a pretty simple process. You have a big bath of molten zinc, and you take some big steel piece in it and you dip it for a while. But there's a lot of science to dip it well, dip it right, and make sure that it's going to last 50 years exposed to the elements. So this has been a growing business for them. It's about 50-50 now. They've been a industry aggregator in this space. The American Galvanizers Association, so yes, there is a lobbying group for this group, says in North America there are a total of about 120 companies with 165 plants that do this kind of work, and AZZ has 35 of them. They bought 3 companies last year, so they've been solely aggregating. They have about 20% of the North American market. The opportunities are getting less, although they are looking in Canada, and they're also made in the last year a purchase in Eastern Europe, so they're looking to go international with this business line. Slow but steady. Next slide. So they have a number of markets that they serve. The top line, except bridge and highway, is basically their electrical business. They also have petrochemical because as a hazardous environment, needing to be controlled and isolated from sparks and other things. There's a lot of synergy there. And then on the bottom is a lot of galvanizing. You see included recreations. It's an amusement park ride. And then the OEM is a little bit of a strange picture. It's a trailer. So there's a wide variety of customers, and these customers are commercial. One thing that helps them as a growing company is they have an amount of predictability. They have a backlog. It tends to be not quite 6 months worth, but they have a pretty steady business from these customers that helps their growth trend be a lot more steady. Next slide again. So this is Aqualex. This is the acquisition they made. Aqualex, they bought one division of Aqualex actually, for repair and safety. For power plants. They do a lot of work with nuclear energy. They do a lot of work with fossil fuel plants. They bought this company for $250 million in cash, which is unusual for a small company, not looking to leverage stock. And they did take on some more debt for this. The debt for this company is a little bit higher than normal, but they're managing it. And again, with a steady order book of business, it's helped to manage it. And it actually will be accretive even in the first year. So as a serial acquirer, although this will be a challenge of a different sort for the company, they've proven that they can integrate these businesses into their main line of business and make them profitable. So that's a little bit about the company. Now if you give me control, let me go into.
Ken, do you want me to get it, or you want to switch presenter?
I have it right now.
Okay.
Mark, okay.
Alrighty.
It's giving me flashbacks, Matt. I used to work in many of those areas.
That's what I heard. Now, before I get into the SSG, let me confess something, because I have maybe an unintended use for manifest investing. Although Mark and Ken always emphasize that we not only want par, we also look for quality and financial strength when we're looking at a company. I very often like to just set a minimum par of 15 and go look at the stratosphere, whether you call it the stratosphere, or the nosebleed section, or maybe you can call it the attic of manifest investing. Just where there's a lot of junk that collects. You can see a lot of those Chinese companies that have foiled many an investor's dream. You have a lot of last year's great businesses or great ideas. You have Groupon. Is Groupon ever going back to a 34 PE? You have Sky People Fruit Juice, which is a good product, but looking to search for a 5 PE, having just gotten an investment basically from an angel investor, they're kind of more on intensive care than an investor's list. There's Titan Machinery, which is a real pain for my groundhog portfolio, and it's a small comfort that it's the undervalued stock for this month. I didn't start out that way at the beginning of the year. But then you get a company like AZZ, and these things interest me in the attic when you think that that might be something of value. So it's not blue, it's not 80%, but it has good financial strength, and it's not looking to shoot the lights out with PE. And those are kind of things that, not in an efficient way, but I like to browse this section and see if there might be an interesting thing. I also thought I'd challenge myself today. I didn't think I would get a lot of credit for coming in.
Crocs right there, Matt. Crocs didn't interest you?
No.
Okay.
Maybe last year. Maybe we're a year late.
Just questioning. All right.
They've been up and down. Actually, until I saw Groupon, Crocs was going to be my example of yesteryear's growers.
Oh, okay. All right.
So I also wanted to challenge myself in today's presentation and say, what would be something a little unexpected? If I picked one of the top 100 picks from Better Investing, I didn't think I'd get a lot of credit for that. So when I look at this, again, the PE is not looking to shoot the lights out. They do have strong sales growth, something to look at. They actually have a dividend, again, unusual for a small company. When they actually initiated it, it was 3%. The stock has appreciated since then, but still a significant dividend. The Motley Fool caps love it. When you look at the quality rating, you do see it does not get a lot of credit for its financial strength, and we can look at that, but the other ones are actually pretty good. Its competitors tend to be very big. Here's ABB, Acia Brown Boveri. Also actually dropped off the top in the industry, but Rockwell was on here. So it is playing against some bigger players, and it has to really watch itself or it'll get outgunned. So let's look at the SSG. So again, looking at the debt, $453 million in debt, with a total debt to capital of 57%, quite high, but lower than it's been in the last 3 years. So they are managing it. Growth rate, actually astounding growth rate, this year because of that acquisition. The year ago numbers are actually pretty out of whack. And decent insider ownership, 8.8%, is nice to see and a nice benefit of a small company. Again, as Mark mentioned, pretty up straight, not quite parallel, but pretty straight. An interesting period from 2006 to 2009. They didn't really have a recession like the rest of the economy. What they had was a boom. Of course, again, they do electrical work, and this boom was effectively driven by the growth in renewable energy. So as you were generating energy out in the middle of the Great Plains or the Southwest Desert where there was nothing, there's a lot of work to do. So if you take those years out, you actually, again, you're still not parallel, because as an industry aggregator, they do a lot about cost savings, but quite straight lines taking that middle group out, but effectively flat in historical sales. So 16.7 was the raw number. If you left everything in, you have 17 here. So there is an aberration there, just as there will be this year with the big acquisition. But actually, it doesn't bother me. There's a finite explanation. So I'm going to leave historical sales at 16.7. It's a little bit less than the analyst estimate, but I think given that they're in the attic, I'll just see if they can carry on. When I look at everything else, so I see the pre-tax profit margin. If I look in the last 5 years, so they did come out of that boom in renewables with a little bit dip in their profitability, but they've managed over 16% in 3 of the last 5 years, so I'm comfortable saying 16%. Tax rate has been pretty steady. There's no tax breaks here. They've been as high as 37s, so I'm going to call 35 as a given number good. Again, although they have not made purchases for shares, they are still a little bit dilutive here, about 200,000 shares a year. So over 5 years, I'm going to say that they're going to be up to 27 million. So this gives an EPS growth of 15. Again, not quite the same as sales growth, quite conservative for a company that's been actually improving earnings over sales. But for baseline, I'll do that for now. Call it good for a quick and dirty one. Going to the back. So going to the back, looking at the trends, pre-tax profit on sales and return on equity, both good and both up. Percent debt to equity, again, debt to equity is high. It's not 30% or less, or as some might want, 10% or less, but look how high it had been. Again, driven by acquisitions, but they're managing it down, and with a steady order book, they can do so. The PE is really quite interesting because, again, so this is something that's been historically growing at 23%. We're projecting 16%, and really you don't see the PE except for a peak in 2012, and actually their all-time high was in April of this year. They really don't get credit for it. You're kind of peaking it at a price earnings to growth or PEG of 1.0 as opposed to 1.5 or 2.0 that you might see normally. So I'm going to go ahead and keep those. There is something, if I might take out, if you see, I'm really worried about these low PEs, again, during the recession. Remember, this was a company considered about or grouped with the electrical business. That would bring me to 17.3 and 11. Actually, I think I'll take those. And not far off, and again, not really rewarding the growth that they're able to drive. Looking for a forecast low price, again, we're at 37 right now. It's right in the middle of its 52-week range. The low was 27 and the high was 47. You can see there's not too much variation. I could go down into the high teens, but I'll call 26 okay. Now, you get here in the buy range, not too bad, 3.8 to 1, and a 14% low par, which doesn't really match. If you go back to the manifest view on this, you wonder, well, where did we get 23.8 from? What's wrong there? The problem with this is when you go back to the front, is really the projected revenue growth. And Mark already corrected it. I'm using raw data off of Toolkit, which really shows 2012, and KZZ does have a different fiscal year. We're actually in the second quarter of 2014, their fiscal year. But starting from a base of 570, whereas the forecast for this year is from 825 to 900 million because of that that large acquisition they did. At 16.7% growth from there, that actually takes us into the neighborhood of 1.4 billion instead of 1.2. So I'm going to do a little aberration with my SSG here, and I know if I look over here, I'm going to say from 570, in order to fake it, 25% growth gets me in the neighborhood of what a steady growth 16.7% from an 800 million base gets me. So it's going to look like I'm saying we're going to skyrocket in growth, but here, let me recalculate that. I went and changed that, and then I didn't pick this back up. But really, I'm accounting for a jump in here without changing the data. And then in the back, I'm not going to reward the company for that. It's not like it's a 25% grower. But what this does do to us is it drastically changes the range. Now, at the same price, we have actually a 6-to-1 buy ratio, and we start seeing a low par, 22.3, that gets us in the neighborhood of manifests par. So this is a company, a small company that has been growing rapidly. It's quadrupled sales in the last 7 years. It has a number of challenges. It has a big acquisition to take care of, although it's a serial acquirer, so it does have a skill in doing that. It's also starting to grow internationally. The company has 20% of its sales in outside the U.S., and it's definitely looking there for its next term of growth. So there are risks here, but the rewards are high, so it's a very interesting small stock.
Good stuff, Matt.
Thank you.
All right, Ken, do you want to go ahead and take us away with 3D printing, or we can probably hold for questions until later?
Okay. I'm going to deviate quite a bit tonight from what I normally present. I might be proving that I'm a terrible speculator. We'll be able to figure that out in the next 3 or 4 years. But I'm going to listen with both of my ears tonight to something George Nicholson said about sometimes looking at non-traditional investments and sometimes trying to gauge what the future will bring and putting a little bit of money to work talking about something that isn't reality today but that might be reality. I'm married to a very talented woman, and one of Natalie's skills is that throughout our investing career, she's been very able to look at the future and to gauge companies that, while they aren't very popular or even very well known when they're being purchased, they ride the crest of what's going on into the future. One of the first stocks that we bought back in the mid-'80s was the gaming company that deals with all of the sports games today. Back then, nobody even knew what computer games were beyond the pawn games that went back and forth and back and forth. But putting money into a gaming company, while it was kind of risky, seemed to be something that the future held. And in fact, that gaming company did prove to be quite a wise investment. In the late 80s, she foresaw the trend of outsourcing. And so our investment in Cognizant Technology in the late 80s was way before anybody had ever heard of the company. And it proved to be an extremely lucrative, extremely great thing to invest in. So I'm going to try to bridge what Natalie and I have been talking about for the last couple of months. I get so many emails throughout the weeks, and they always say, Ken, why don't you just tell us what you're thinking about today? So I'm going to share what I'm thinking about today. I want to caution everybody, however, that while I see change ahead, and this might be the next big thing, I'm also the person that recommended buying hogs 2 years ago. So keep that in mind as you listen to my presentation. I'm going to focus on an industry because when I study a stock, I always study an industry. And I've identified 5 companies in an industry that really doesn't even exist today. If I look at any of the stock databases and try to call up printers, 3D printers, and I would like to use the word replicator rather than printer, I really don't find any companies listed in that industry because that industry is not even listed. In fact, I find these companies in various industries at the present time, but I think if we're going to create a new industry called 3D replication, that these 5 companies definitely would fit into the system. Now, 2 of these companies are extremely small, and one of them is very small. There's 2 good-sized companies in this new industry that I'm creating. But let's talk about the 5, and we're not going to go into any great depth. I'm not even sure that I want to share a completed stock selection guide with you, other than to make some cautions about a couple of things. But let's talk a little bit about these 5 companies that are on your screen. We'll start with a French company. You can buy it as an ADR. It's marketed on the pink sheets over the counter. It's called Dassault Systems, and basically they're a software marketer for 3D replicators. They don't actually make the machines, but they have a huge presence in 3D software, and they compete directly with the 2 large American companies, Stratasys and 3D Systems. They compete directly with those 2 companies worldwide, and in fact, Dassault seems to be the leader in Europe, and it's giving both the other companies a very, very good run for their money in Asia. They offer design and support for 3D replication. They're a very acquisitive company, so they're growing very, very quickly. You're not going to find data about them in the Morningstar database that you buy from Better Investing. You're not going to find a value line on Dassault. It's not even covered by Manifest Investing. But if you're interested in the company, you can find huge, copious amounts to read about this company. Go to their website. They have some pretty nice presentations in the form of movies that you can watch, and then start searching. Use the internet for what it's great for, and that's looking for information. Eventually, you can start to put together a pretty good picture of this Dassault Systems. I don't know if Dassault Systems is the next Apple computer, or if it's the next IBM, or if it's the next Commodore computer. I just don't know. I don't have that kind of a crystal ball that I'm using, but right now this company is certainly in the thick of things when it comes to 3D replication. The next small, very, very small company that I'd like to have you take a look at is called XONE. And again, you're not going to find very much information on XONE. Again, it's not even in the Better Investing Morningstar database, and you won't find it covered by Manifest Investing either. They call themselves a disruptive industrial 3D printer. And you'll notice that they basically are dealing with a lot of hardware. 41% of their revenue comes from 3D printing and laser machine sales, and 59% of their revenues comes from these PSCs, these production service centers, where you would physically travel in order to do 3D replication for a single piece of something, or maybe an idea, maybe a prototype, maybe you'd like to make some consumables that you're going to sell in a retail setting, maybe you're going to replicate some replacement parts. But whatever you might be doing, you might not have the funds to buy the printer yourself, so you'd go to one of these production service centers and they'd basically do the replication for you, kind of like a Kinko's on steroids here. XONE makes Max platforms, they make printer platforms, they make flex platforms, and each one of them deals with different materials. Go down to the bottom of each of these columns, you can see that they can make product out of many, many different types of materials. So we're not talking about just little models that might come out of a replicator, but we're talking about things that you can actually use, things that up to this point we had to manufacture with many, many different types of machines, and today we have machines that can replicate in one fell swoop using materials like stainless steel and glass and bronze and ceramics. You can see that XONE is penetrating the industrial population. Here's just a partial listing of some of the companies that use their applications. They range from the automotive industry to power fluid, many other industries, and these are worldwide companies using this technology to make parts. I think that this is going to change manufacturing, at least manufacturing the way that we know it. And a lot of the materials that I've read so far think that this is the beginning of the end for what they call the Made in China syndrome. XONE is focused on diversifying their revenues, so they diversify not only by product line, but they make a real strong attempt to diversify by region. You can see that their income is coming from the Americas, from Asia, and from Europe. So they're a worldwide company, even though they really are quite small. Notice their guidance that they've given for the 2013 year. I think a company has to have a lot of chutzpah to give revenue growth guidance of 65 to 80% and to at the same time say that their gross margins will be somewhere in the 40s up to the mid-40s. I really am marveling at the size of these numbers, and I just captured a few facts at the top of this slide. I'm cribbing, of course, from presentations that you can find on the websites of all these companies, and if you're going to study this kind of replication, I urge you to go to these companies' website. This next slide is another company in this field. Again, very, very small. You're not going to find value lines, or it's not going to have information in the databases. Manifest doesn't cover it. And the company's name is Organovo, or Organovo, or something along that line. And I found the picture extremely interesting. That's an actual picture of making functional human tissue using three-dimensional bioprinting technology. And to me, the most interesting word in that whole sentence was that word functional. They're making functional human tissue, and they're basically printing it. Here's some highlights from this company. Again, great website, lots and lots of information. Organovo's NovoGen bioprinter, named one of the best inventions of 2010 by Time magazine. So they've been around for a few years. Take a look at what they're doing right now. In April 2013, they're bioprinting liver tissue. How many years before they can print new organs? This is what I see as disruptive technology. Now we get to one of the bigger companies in the replication field. You will find this covered in the database and value line, and Manifest does cover it as well. Stratasys, where they make concept models, prototypes, and actual production parts. They're involved in all three of these strategies in replication. So you can have an engineer sit at his desk and make a concept. You can have a small team turn out some prototypes, and then if you like what's happening, you can print the whole entire object as production. Again, that's completely different from the way we used to manufacture things. Here's some examples of the types of replication that they do and the types of materials that they use in order to do it. We're talking about thermoplastics and resin and wax, where you can turn out prototypes. The series go from small printers that could be used for individual modeling. Think of these sitting on an engineer's desk, to design series machines, which could be sitting in a room that a team might use, to huge production machines that can actually repeatedly and cost effectively produce parts at a very, very fast rate, do it very precisely, and do it with and without the presence of a lot of other machines. Here's the targets that this company, Stratasys, has set for itself. They've set a revenue growth target of 20%. They came close to it in the first quarter of this year at 18%. There's some other targets that they've set. These numbers that I'm finding on their website and as I read might help you in putting together a stock selection guide for this company. And here's the last larger company in this industry, 3D Systems. Look at the forecast for 3D replicators moving to 2020. The forecast is for a compounded annual growth rate of more than 20% for these printers as we move through the next 5 or 6 years. They're going to be sitting on your desk, in your classroom, in your laboratory, in your factory, and 3D covers machines that right now you could conceivably put some money into. I can remember back when we had VCR projectors, video projectors from our computers where we paid more than $1,300 for them. So a small replicator might be something that you'll end up with on your desk if you're an early adopter of this technology. Notice the mid-range machines from $20,000 to $250,000 and the high-end manufacturing machines from $250,000 to $1 million a piece. The company deals with all of them. They have 100 different materials that they can put through these different machines. Think of the engineer's desk of the future, what it might look like, and the kinds of machines that the engineer can go from something he sees in his mind to something he can hold in his hand in a period that's way compressed from the kind of period that we presently see in product development. We can deal with medical replicating. We can make aerospace and automotive parts with these large replicators. Here's an example right now that's being done by one of the 3D companies, one of the companies they've acquired. It's an orthopedic brace company where they capture the actual arm or leg or whatever the limb is that they're trying to build a brace for, and then they create a model, exact fit for the arm or the leg or whatever you're bracing, and then they print one of these objects so that the person can actually use it. I think that this type of technology is disruptive technology and that it will change the world in the next 10 years. Think about what video gaming has done to the youth of America, or the Model T, or the IBM personal computer, or the cotton gin, or the first transistor, or for that matter, mainframe computers. Think how disruptive each of these inventions was, and think of the opportunity that was there for investors to get in on the ground floor of something that would be proved to be completely disruptive of the way we live. Here's the stock selection guide for one of the companies that we can actually take a look at. This is the visual analysis for 3D Systems, ticker DDD. And notice that we've had some pretty up, straight, and parallel for the last 2 or 3 data points here. Will that trend continue? Will this company turn into a classic growth company at the very highest levels of growth? Or will this company end up on the trash heap like some of the companies we can think about in the computer industry or the computer chip industry or indeed in the automobile industry for that matter? Here's the SSG, the visual analysis for Stratasys. And again, are we beginning, is this relatively small company gearing up for consistency? I noticed that the last 4.5 data points in sales have been amazingly consistent. That's a nice straight line. And except for the recession between 2008 2009, I see sales were steadily improving. Can the company match earnings with those sales so we end up with the kind of strong growth company that we're interested in investing in? Only time will tell. But for my choice on the roundtable tonight, I'm going to do a little bit of dreaming, and I'm going to put my money into DDD, 3D Systems, and then I'm going to see what it looks like 3 or 4 or 5 years from now. Thanks, Mark.
Well, thank you, Ken. We have a lot of questions coming from the audience regarding coverage by the various agencies. I'll tell you what I'll probably do is, for example, Stratasys was just initiated in coverage by the Value Line Standard Edition, and XONE has just been added to the Value Line Small and Mid Cap Edition. So they are out there and kind of building, but we'll probably put links to where you can find some information on all 5 of those. That XONE seemed pretty fascinating in terms of where it's emerging and that type of stuff. Solid presentation, Ken. Thank you. I think back to Google as a disruptive technology, or another company that might fit this even more directly would be Intuitive Surgical. To go back and look at Intuitive Surgical 15 years ago, might be interesting to do some looking at how it was perceived and basically how it unfolded to see some of the stuff that's going on here. So again, thank you for bringing this to our attention. I've personally run into this in a couple of areas. Ken and I have talked about this offline. Detroit's becoming kind of a center for this, kind of a renaissance. There's these things called fab labs where they do a lot of the replication style printing and stuff. So we might get the opportunity to see this stuff in action. And as we have speculated, the day might come when you actually print an automobile. So pretty wild stuff.
Well, when you think about dreaming, I know I saw a NASA paper that said that a manned Mars mission will probably print their food. But think about if you're years away from anyone else, how empowering for your survival would be. You don't have to bring everything. You just need some raw materials, and then you make what you need when you get there.
I think what amazes me more than anything else, Mark, is this initial work being done in the medical field, because I can see so many things that right now sound like they're right out of Mr. Spock and Star Trek. But
oh yeah.
But what you could dream of in the future for replacement of parts, only making them human body parts. That's just really fascinating and exciting as far as I'm concerned.
Yeah, the thing about the Star Trek stuff is it keeps coming true. Well, on your screen right now, I've gone ahead and just want to make a point, and this is where the dreaming comes in. Maybe we'll get Natalie involved here. This is a look at 3D Systems, but again, trying to peer a little bit more than usual into the look ahead next couple of years. And as Ken said, this is really straightening out here. But also, Value Line gives us a 3 to 5 year estimate out here. Now they are notorious going back, and again, this is where I think if you went back and studied Intuitive Surgical or maybe a few other emerging type companies, especially technology companies, they do tend to be kind of pessimistic out here At the same time, boy, if you're wrong and get overly optimistic, you can get hurt pretty bad as an investor. So again, I would say just encourage people to make sure that you pay a lot of attention to the right-hand side of those trends as you visualize the trends and you think about, you know, what the future might hold out here. Good stuff. All right, let's go ahead and move on.
You know me well enough, Mark, to know that I subjected DDD to the manifest methodology before I even began talking about it in public. So.
Yeah, and in fact, when you take a look at that and you embed some of the analyst consensus stuff, you end up with a company that is not as pessimistic as Value Line is right now on it.
Absolutely.
All right, let's go ahead and keep on trucking. I'll keep it short and sweet tonight. I do, as usual, like to go shopping with the ivory screen, so I'm basically screening for companies that are in the top half of 1% based on the combination of their return forecast and their quality rating. I would demonstrate it, but we're going to run a little bit short on time. So again, we're focusing in on companies that have high quality ratings and high return forecasts. You can see Coach makes the top of the list thanks to their price drop down to the $53 range here over the last couple of days. And then a number of companies, in fact, one of the ones that I wondered about is this one in 3D printing at all. I'm not sure that they are. But a whole bunch of fairly interesting companies, some companies that have been selected here at the round table, including NetEase, Qualcomm fairly recently, Landauer, which would be in all the industries that Matt described for AZZ. And then a year ago, Ken and I both selected Fossil. By the way, that one's up about 100%. And Infosys Tech has also been a fairly frequent recommendation. But focusing up here on the top of the list, I'm going to focus in on why not Coach. And then I'm just going to skip over Vistaprint on the basis of they just have a little bit lower financial strength rating right now. And with the overall market return forecast down in the 4 to 5% range, I just don't have a stomach for the companies with the really low financial strength ratings, so I'd throw this one out for now. It's a good company and a good study, and one that's done extremely well here lately. But I would just go on, and then we end up down at C.H. Robinson with basically across the board fairly strong characteristics. Why not Coach? Well, Coach is a company that it's an absolutely spectacular industry leader. It goes through periods of retail schizophrenia, or whatever you want to call it. You can see that every once in a while the momentum just takes over and it surges up to an overbought condition like the one back here. And then it proceeds to go into a period of price disruption or turmoil. And when it gets bad enough, the price momentum, anytime this is negative here, that means that the price momentum has gone negative. And it can get pretty hairy, and this is a massive drop, basically from the 50 range down to approaching 10. So that's an 80% drop back in the Great Recession. So again, it's the type of company that can really misbehave, especially when the Wall Street institutions and herds decide it's time to pick on it. Well, Goldman Sachs issued a sell recommendation on Coach this morning. So that's got something to do with the fact that it went down to 53 today. And the other thing that we like to point out is, again, it got kind of toppy here a couple years ago, topped out at a price in the high 70s, and it has subsequently come back into this range, which gives me the heebie-jeebies. Anytime it goes negative in the price momentum, that's the rate of change over a 9-month period, and it's actually gone back negative here. This would make me extremely nervous, and again, absolutely excellent company, exceptional return forecast, but it's kind of the answer to the question, not now, not just now, because there is a potential for fairly significant erosion to the downside, in my opinion, based on just studying history. And again, you can see that Coach, even though its return forecast is fairly elevated, there have been periods which were actually better, and better situations. Quality is unassailable up at the top of the charts. It's definitely top shelf quality. Let's talk about the one that I did pick. Again, this is a repeat selection. For those of you unfamiliar with the company, it's a trucking and logistics company headquartered in Minneapolis, extremely well managed. Over the years, they basically move stuff from point A to point B. However, if Ken's replicating printers get up to full speed anytime soon, that's got impact on these guys over the long term too, I would think. Interesting thought over the long term what that would do to the UPSs of the world and that sort of thing. But this is a pretty cool company, very well managed. You can see that with the exception of the Great Recession, where there was a little bit of a downdraft in sales, a little bit of a flattening or plateauing of earnings back during the depths of that economic test. Other than that, it's basically up straight and parallel. And you can see that by the price bars, it actually has come to where the price bars are beginning to approach the earnings trend. And that's a potential for sale company. We pay a lot of attention to the low total return forecast because we find that one matches our forecasts most often at Manifest. And we see that, again, with the average at 5%, if you can find a legitimate, considered 13%, pretty good stuff to have. So we're talking about upper single digit, 10%-ish type growth with a total return of 13% according to Value Line. Pretty good stuff. Here's a look at it from top to bottom using the key characteristics at Manifest Investing. Again, about a 10% growth rate. You can set a watch to their profit margins. Call it 4%, year in and year out. 4.3, 4.1, 4.4, 4.2, year in and year out, to 4%. The high quality characteristics of the company does generate and merit fairly high PE ratio over the long term. So it's a little bit elevated, but that's out of respect. And you stack up that $12 billion company at 10% growth, 4% margins, and 20% PE ratios, and you end up with a projected return somewhere in the mid-teens, and we like that. A little bit longer term look going back to August 2009, the time series graphic shows that the price has been at higher levels in the past. It's been kind of sagging off. I blame the recession and economic conditions for a lot of that, but this is a company with, again, strength of quality, and we're looking at a company that has, we're looking at a company with a return forecast up at levels, the highest levels that we've seen in the last 5 years. So it draws my attention, and we'll make a repeat selection of C.H. Robinson for the tracking portfolio. So with that, we can probably go to the poll, Ken, and we probably do have a little time for questions tonight.
Okay, Mark, I'm going to launch our poll. The poll is now open, folks. We'd love for you to vote.
We didn't cover Caterpillar too much tonight, but Hugh has wanted to double down on that. He pointed out that there is a lot of loathing going on. The company is engaged in a stock buyback program, and he just loves it when they simmer and slug it out for a while at lower price levels while he's accumulating shares. So he sends his best regards and certainly understands.
Give us about 10 more seconds here. We have 90% voting right now. If you haven't voted, just take your mouse and pick one of the letters on the screen there and give us a vote.
Another dead heat tonight.
And I'm going to close the poll.
Wow.
And I'll share the results. And look at that, 34% C.H. Robinson, 34% 3D Systems, 28% AZZ. It's almost a three-way race there, Mark.
Yeah, that's a photo finish. I guess we'll have to go with another double selection for the audience. That's what they did last month. And by the way, their two selections last month, they're outperforming everybody else. So good stuff. Yeah, I don't think you can go wrong with any of the three. All right, well, with that, I do want to spend some time talking about, Ken and I are going to hop on our horses and go on a quick trip here about a month from now, and we're going to make a few stops in Springfield, Illinois on August 22nd, Oklahoma City on August 24th. Then we're still working with Wichita or Kansas City to nail down a place for a venue for that evening. And then we're going to spend August 26th with a bunch of long-term investors in St. Louis. So again, keep those in mind. If you're within driving distance of those, most of those are evening programs. The Oklahoma City program is an all-day program. So if you're within driving distance of any of those, check the Manifest Investing Events listing. Well, there will be more information on all of those here over the next day or so. And then, of course, a month from today, August 27th, is our next roundtable online. So if you have any questions, you can email Ken or myself about any of those opportunities. We will be in contact with subscribers and prospects in all four of those areas, and urging them that it'll be an opportunity to come out and share some thoughts.
If you aren't currently on the list to be reminded about the roundtable, if you drop me an email, I'll add you to the reminder list, and once a month we'll send you a real short invitation to join us for the roundtable and remind you on what the date's going to be. Again, we're going to stick with the last Tuesday for August. That'd be August 27th. If you would like to be on the reminder list, just drop me an email.
With that, do we have any questions or comments? I got a kick out of all the presentations tonight. I want to thank you, especially Matt. Outstanding presentation tonight.
Thank you very much. I think it would have been hard to fit Caterpillar into. I'm sure he would have been succinct with it, but I have a fun time. You don't have to offer me a lot of incentive to come talk stocks.
Nicely done.
We'll keep that in mind, and we'll certainly be asking you and Hugh to help us out again in the next year. Herb, you keep yourself ready to go as well. We haven't forgotten you.
Well, we do show it's just a little over an hour. We typically run this about 75 to 80 minutes, so if the audience has any questions, we certainly can open up the floor.
Okay, we're looking. I'm looking at some of the questions. Some of the folks have left already. I want to repeat that my choices tonight, the whole idea of 3D replication, was something to stir your interest in going out and beginning to do some of your own research. It's going to be very difficult to find information from an analyst covering some of these small ones, Organovo, for example. But if you go out and start to read, you'll begin to get some pretty decent information which you can place into a stock selection guide. Remember, you don't have to take your data electronically. You can do a stock selection guide by typing in information the old-fashioned way. Nancy Hogan would like to know any idea where Natalie goes for researching up-and-coming companies. She goes to the same place I do, the library and the internet. Folks, if you really want to study companies where the research companies like Value Line and Morningstar just aren't quite up there yet, you have to go out and do the hunting yourself. Make friends with a great business librarian in a local library. You'd be surprising how much they can help you find information, especially about companies where the information is few and far between.
Just as a case in point, I thought I'd demonstrate for the audience this XONE company that you mentioned tonight, Ken. The information is pretty sparse, but if you go to Morningstar and click on PDF report, you actually get a pretty good view of what's going on. I find it just at a knees glance pretty fascinating. Let this come up here. And it definitely qualifies as a company at that emerging point in its life cycle. You can see there's fairly limited information on here, and I believe it's also available in the Value Line Expanded Edition. Let me check my notes. Yes, it is. So you can actually see fairly limited information. In fact, let me go to Value Line, because that's going to be the format that most of you know and love. And you can see my study there on C.H. Robinson. But if you type in XONE, I didn't update this computer, so actually it is not caught up with the update. It's brand new to Value Line. And what was the other one that Well, Stratasys is actually covered in the standard edition as of this
Right.
week.
Stratasys just moved into the standard edition, right?
So again, if you go to Morningstar, you can typically find a fair amount of information, even in the case of that French company, which, by the way, they have a major office here in Auburn Hills, Michigan, that drive by almost every day. Here's that company. Again, a whole lot less information available, but still some. And if you go to their PDF report on the company, I'm not sure why I'm getting such a nasty picture, but this company's actually been around. And as a case in point, Ken talked about how established they seem to be in this line of work. Take a look at these numbers on, if you look at nothing else other than these net margin numbers. Basically nailing 15% across the board. So that's that Dassault Systems, or Dassault, I'm not even sure how to say it either. D-S-T-Y. Is it Dassault?
Yeah.
Have you ever done any business with them, Matt, or have any awareness of them?
Yeah, their CAD system, CATIA, is the standard for all the European automakers. So I work for an auto supplier, so we have plenty of CATIA around.
Okay. I also noticed they're doing something with portfolios. That's something I wanted to take a look at. Some type of 3D technology when it comes to portfolios. Go figure.
Mark, we're getting a question about Five Guys. Does anybody know whether Five Guys is a stock holding company? Can you invest in Five Guys? It's a hamburger chain out of Washington, D.C. with about 1,000 stores. I don't happen to know. Mark, do you know anything about Five Guys?
No, but we can run them up the Morningstar flagpole and see if we get anything here.
While we're looking there, Cheryl Pattison just has a comment for us. She says hospitals here in the D.C. area are using 3D printers to make 3D copies of organs for the doctors to study prior to surgery with that organ and predict any challenges that the surgery may have.
Very interesting.
Linda Schuler is telling us that she thinks Staples started selling 3D machines. You might want to take a look. If so, boy, I'm tying right into Mr. McManus here, aren't I?
Yeah, I believe they sell the $1,300 model.
Yep.
I don't know that I've ever seen a Staples that had one on display, but that would be pretty fun to play with.
Yeah, I'm pretty sure they do too, so could be some fun. Now, I didn't get anything on Five Guys. Might take a look at Hoover's to see what it has to say. Probably still private. Hoover's Handbook of Companies. Any other?
Mike is telling us that he thinks he can use some of his parts replacement right now. So
the demand is there.
The demand is there, right?
I have a left ankle and a right shoulder that's a candidate. But, you know, one other thing that does come to mind, my dentist is actually thinking about putting in 3D printing of crowns. And, I mean, again, that seems like a pretty legitimate thing to
Another
pursue.
application, Mark, that I've come across, do you know the Invisalign systems where you basically wear a mouth guard to realign your teeth?
Yes, I do.
Those are now being printed so that you can change those on a very quick basis at a dentist office. They can be custom printed for your mouth, and the dentist can change them any way they want to. But that whole Invisalign system is now being printed with 3D printers.
Fascinating stuff. Well, we did record this tonight, so it'll be available to send to your friends.
Nick Strategos is telling us the three guys is private. He has that direct from their website.
Cool. Thanks, Nick.
And Mimi says that Five Guys is all over the Phoenix area. It's very popular. Mimi, do you know that from personal experience, or are you telling us secondhand here about it?
I think it's field research, Ken.
Okay.
Right. Any other
Mark,
comments?
we have one hand in the air right now. Let's see if I can figure out who it is. The hand is from Nick. Nick, go ahead. Are you going to heckle Mark about the Pirates game tonight?
Nah, I think I'll leave him alone on that one. Actually, what I would just to follow up on the Five Guys, I'm on their webpage and it says that it's privately owned and they don't have any plans to go public. However, we do get these questions a lot and we take it as a compliment. Thank you. And,
wow.
And I can tell you myself too from my own personal research, they do make a heck of a hamburger. There's one right here in my neighborhood, so.
Well, we'll have to come over and check that out with you.
Yeah,
I
it's
think
actually
Five Guys is following the Subway version.
Yeah,
they're franchised, and that's all the capital
Right.
they need.
They're franchised. They have over 1,000 stores at this point.
Wow.
So.
They haven't gotten this
yeah.
far north yet, but maybe they're in the Detroit area. I don't know. Or do you have?
Oh yes, they are. Actually, there's one in Grand Blanc, Ken.
There's one in Grand Blanc now. Well,
Yeah.
that's the ritzy section of the county. Travel in that
Yeah,
county.
that's,
And when you
Spielman
when you
hangs
guys
out.
were here in Pittsburgh, you were only about 2 minutes away from the Five Guys. So
Oh, all right.
they're right in one of the little strips right out there on 19, outside of where the Sheraton is.
Great. Were you here for the whole session tonight, Nick?
Yeah. Well, I goes in about 5 or 10 minutes late.
Yeah, we celebrated Route 21, and you're going to have to come back and replace it.
That's exactly when I came in, actually. So that was fortuitous timing.
Well, take a bow, man.
Thank you. I appreciate it. And it's kind of funny that over the summer I've been coaching softball, and my daughter was asked to play up on one of the teams, and I was talking to the manager of that team, and he's actually in the tax department at Root. And so I said, thank you, because I actually bought some of the stock. Unfortunately, I didn't buy it in February. I bought it a couple months later, about $2 more a share, but I'm not going to complain, 26 versus 28 when it sells off at 42.
Right.
So, and I did recently sell mine off because I don't expect after they closed out the opportunity for anybody else to come in and put in a competing bid for the price. I don't expect it to go anywhere. 42 is where it's going to sit. So,
Yeah, I saw that.
took it. If you saw, you'll never guess who I bought, but C.H. Robinson was one of them.
Wow.
So I moved the money over there.
I feel special now.
Thanks a lot, Nick. Thanks a
No
lot.
problem.
All right.
Mark, my martini has arrived, and I don't want it to get warm, so I think we've covered most of the questions and a lot of the comments. So I'm going to thank you, and especially Matt, well, especially both of you I'm going to thank for coming tonight and for helping out the Mid-Michigan chapter. And again, we'll see everybody with the Knights of the Round Table on the 27th. And if you're anywhere near Springfield or St. Louis or Kansas City or Oklahoma City, come join us and say hello when Manifest Investing visits those places and talks about investing. Thanks for coming tonight, folks. We really appreciate it. Good
Thanks,
night.
Ken.